Every financial crisis seems to come with an easy villain. In 2008, people pointed at Wall Street greed, reckless borrowers, or simply bad mortgages. But the real story is stranger. The most powerful banks in the world weren't technically banks at all. They took in deposits that weren't called deposits, made loans that weren't called loans, and ran a global dollar system in the shadows, until the day the lights went out. And here's the paradox. The institutions that triggered the panic didn't die in it. They won. The shadow banks didn't just survive 2008, they became the system. Debt and credit are not just ledgers. They are plumbing, pipes, valves, and pressure gauges that move trillions around the world. For decades, more and more of those pipes were built outside traditional banking charters. By 2008, the shadow network, money market funds, broker-dealers, structured investment vehicles, securities lenders, mortgage conduits, had grown so large that its promises felt indistinguishable from insured bank money. The promise was simple: safety, stability, same-day access, cash equivalents. But they were only equivalents until confidence cracked. When it did, the world learned that modern money is less about vaults of bills and more about collateral and belief. Strip away the jargon, and the mechanism is familiar. A classic bank takes deposits payable on demand and turns them into long-term loans. It transforms short into long and illiquid into liquid. A shadow bank performs the same magic without a banking license and without the insurance that most people assume stands behind something that behaves like cash. A money market fund lets institutional cash sit in a share class that can be redeemed daily, so it feels like a deposit. A dealer finances an inventory of bonds by borrowing overnight against them, so the loan feels like free liquidity. A securities lender or a structured vehicle raises cash against collateral and passes it along to the next player in the chain. The names change, the economics don't. Borrow short, lend long, and pray the crowd never heads for the exit at the same time. This world took shape in the cracks of regulation. In the 1960s, Eurodollars, US dollars held offshore, multiplied in foreign banks and branches outside the reach of American deposit insurance and reserve rules. They looked, felt, and paid like dollars, yet they lived beyond the traditional safety net. In the 1970s, money market funds offered something banks couldn't: market interest on cash, neatly sidestepping caps on deposit rates. Investors learned a new phrase, cash equivalent, and treated it like a promise. In the 1980s, securitization transformed bundles of mortgages and loans into tradable bonds. Long, illiquid loans became portable slices of cash flow. In the 1990s, the repo market, short-term borrowing backed by securities, went from quiet financing tool to the heartbeat of global markets. Treasuries were the gold standard of collateral. Agency mortgage bonds were nearly as good. Soon, almost anything stamped 8LA could be funded at wafer-thin haircuts. The pattern was reliable. When rules bound traditional banks, credit didn't disappear. It changed costume. By the early 2000s, the machine hummed. A mortgage lender extended a loan. An arranger pooled thousands of such loans and carved the cash flows into tranches. The senior pieces, modeled to withstand waves of default, earned the coveted AA mark. Dealers financed those AA bonds in repo, posting them as collateral to borrow cash overnight from money funds and corporate treasuries. That cash behaved like deposits, redeemable, steady, safe. Leverage multiplied because haircuts were low. If a lender would advance 99 cents on a dollar of collateral, a dealer could hold enormous inventories with tiny slivers of equity. Collateral begot more collateral. The system printed money-like claims on illiquid reality. Two ideas made this feel indestructible. First, diversification and tranching could manufacture safety out of risky ingredients. Second, that insurance, credit default swaps written by strong institutions, would backstop the tail. Ratings agencies stamped complex risks with simple letters. Letters became money. CDS writers, confident in models and history, sold protection on the assumption that a national decline in house prices was almost impossible. Regulators allowed those stamps and contracts to substitute for judgment. If the piece said AAA, it could be treated like near cash. If a CDS is insured, it could be treated like hedged. In a casino, the chips look identical until the house declares some of them fake. Crises often move like a slow-motion stampede. Early 2007 brought the first tremors. Rising delinquencies in subprime mortgages, the kind of adverse selection that tranching was supposed to absorb. 2 hedge funds imploded on mortgage bets. Haircuts, the discounts lenders demand on collateral, began to creep up on mortgage-related paper. A small change in a leverage system is not small. If a desk relied on 99-cent financing and lenders now wanted 95, the dealer had to fund the gap or dump assets. Either way, the pressure rose. By the summer, European and American banks quietly admitted funding stress. The interbank market grew suspicious. If nobody could be sure what a counterparty owned or what those holdings were really worth, nobody wanted to extend an uncollateralized loan overnight, let alone for weeks. March 2008 delivered the test case. A major dealer, living on repo funding, faced a run. Collateral that once funded at 1 or 2% haircuts suddenly required 10 or 20, or wouldn't finance at all. Liquidity vanished because trust vanished. Over a frantic weekend, a rescue sale was arranged with central bank support. It was an unmistakable message. The dealer network, the market's circulating system of credit, was already in cardiac distress. The summer brought no relief. Housing kept falling. Structured products kept rotting. Counterparties kept tightening. The machine needed rising prices and eager lenders. It got neither. Then came mid-September. A primary dealer failed outright. If that name could evaporate, anyone could. Investors grabbed for the few things everyone agreed were good: treasury bills, central bank reserves, plain cash, and insured accounts. The next day, a large money market fund announced losses on short-term paper issued by the failed dealer and broke the buck. For decades, money funds had sold the illusion that a dollar share would always be a dollar. Now the illusion cracked. Institutional investors bolted, commercial paper markets seized. Corporations that relied on rolling short-term IOUs to fund payroll and inventory suddenly faced uncertainty about Monday morning. This was no longer a Wall Street morality play. It was the funding of the real economy. Repo markets spun into a doom loop. Lenders demanded higher haircuts on anything but the cleanest collateral. Borrowers met those demands by liquidating assets in fire sales, which pushed prices down, which justified even higher haircuts, which forced more sales. Everywhere, balance sheets shrank. Everywhere, leverage unwound. The crisis was not merely about bad mortgages. It was a bank run on non-banks, fueled by money that wasn't called deposits, but functioned like them until the instant it didn't When the storm hit full force, the response revealed who truly ran the bloodstream of modern finance. Policymakers didn't just protect commercial banks. They built new emergency organs to keep the shadow network alive. Facilities appeared that allowed dealers to swap questionable collateral for cash or for treasuries. Lender of last resort widened into market maker of last resort. Money market funds received backstops and guarantees so that institutional depositors would stop fleeing. The central bank began purchasing commercial paper directly so companies could pay wages and suppliers. Programs expanded to buy agency mortgage bonds and treasuries in size, compressing yields and reflating collateral. Dollar swap lines stretched abroad, shipping liquidity to foreign markets where offshore dollar plumbing was seizing. The message was simple and radical. If markets create money like IOUs at systemic scale, the state will stand behind them when confidence shatters. Rules tightened after the panic. Banks were told to hold thicker capital cushions, carry more high-quality liquid assets, and rely less on overnight wholesale funding. Money market reforms forced some funds to float their share prices and adopt gates and fees to slow stampedes. Derivatives migrated to central clearing to simplify webs of counterparty risk. In theory, shocks would travel shorter distances. In practice, credit behaves like water. When one channel is dammed, the flow looks for new banks to carve. Activities that once lived on big bank balance sheets migrated to non-banks. Private credit funds, finance companies, securitization conduits reborn under fresh branding. Collateral chains shortened for a time, then lengthened again as memories faded and the hunger for yield reasserted itself. Risk returned dressed as safe income. Why did shadow banking win? Because the rescue prioritized functionality over justice. The question in the heat of September was not who deserved to be saved, it was what would keep the payments system alive when businesses opened. The payment system was no longer just insured deposits moving between chartered banks. It included repo financing at dealers, cash parked in money funds, short-term IOUs issued by blue-chip corporations. Saving that ecosystem meant blessing it. Once blessed, it became mainstream. The result was a shift in the definition of money and in the role of the central bank. Money became more market-based, fewer simple deposits, more shares and claims that behave like cash as long as markets are calm. Central banks moved from referees to players, from backstopping banks to backstopping entire asset classes. Price stability expanded into collateral stability. If the key collateral can always be turned into cash at a fair price, the gears of funding keep turning. If not, they grind, and the economy stalls. Managing that boundary between private promises and public support became the core craft of modern monetary policy. The translation to everyday life was messy and unequal. Households discovered that cash equivalents were only equivalent until the government made them so. To stabilize the pipes, policy crushed yields on safe assets for years. Savers earned little, borrowers gained easy credit, asset owners gained the most. The risk of systemic failure did not vanish. It was socialized at the top of the structure and privatized in the profits below. Democracy chooses the leaders, but markets decide who survives a run. In 2008, survival required turning shadow money into official money for as long as it took to calm the crowd. The behavioral tells that drove the crisis haven't changed. Anywhere institutions borrow short to hold long-dated risk, the ingredients for a run are present. Anywhere investors treat complex paper as safe collateral at minimal haircuts, the system is quietly printing money. Anywhere a product promises daily liquidity while earning returns that logically require liquid assets, a gap exists that must be filled by someone's balance sheet during stress. And anywhere market participants assume the state will save them because it once did, incentives shift long before the next shock arrives. Shadow banking isn't a location, it is a behavior, creating money-like liabilities without money-like safeguards, then relying on the public to supply those safeguards when panic strikes. The lesson for anyone protecting savings is unsentimental. Don't confuse cash-like with cash. Read the terms on any liquid investment and ask who is obligated to do what and on what timeline when prices move fast. Respect maturity, mismatch. If an offer promises daily exit but delivers an above-market yield, the difference is funded by someone else's risk tolerance, possibly yours in the worst week of the year. Watch haircuts and spreads because they are the market's fire alarms. When haircuts widen, balance sheets shrink. When spreads jump, funding prefers the exits. Recognize that the state's safety net is real but selective. It usually rescues the pipes first, and households later. If stability matters in a crisis, place funds in the parts of the system most likely to be supported quickly. Insured deposits, direct treasury claims, plain structures with simple promises. The heart of 2008 was not the morality tale of greedy bankers and hapless borrowers. It was a physics lesson about liquidity. Liquidity is not a pool one can drink from at will. It is a crowd behavior. It exists because most people believe they will not need to run. It vanishes when that belief fails. The shadow system offered liquidity by borrowing overnight against collateral that markets agreed was good. That agreement lasted until it didn't. When confidence collapsed, the official sector intervened, not as a scolding parent, but as a fire brigade, blasting water through hoses into a neighborhood of houses built too close together. The fire was contained. The neighborhood remains. The deeper change happened after the flames were out. With new tools in hand, central banks learned to manage not just interest rates, but entire curves of yields and entire universes of collateral. Markets internalize that learning. An investor today buys a mortgage bond or a corporate note with an additional unpriced feature, a reasonable expectation that in the worst hour there will be a bid from a balance sheet that prints the currency. That expectation is powerful. It narrows and spreads in quiet times. It extends risk appetites. It also pushes the frontier of what counts as safe, step by cautious step, until a new shock redraws the line. The story of how shadow banks went mainstream is a story about how power moves. Regulation squeezes, innovation slips, scale grows, and then crisis reveals the truth. The substitute has become the system. In 2008, non-banks had grown so integral to money's daily motion that saving the economy required adopting their pipes into the official waterworks. The backstop expanded to cover them, and in doing so, it pulled them into the daylight. The result is not a darker world or a brighter one, just a more honest one about what money has become. Transferable claims supported by collateral, confidence, and a public promise to be there when private promises strain. There will be other panics. The details will differ. Perhaps the collateral will be different. The locus of leverage somewhere new, the alchemy of safety produced by fresh acronyms. But the behavior will rhyme. Promises of constant liquidity will collide with the laws of crowds. Market-based money will outrun its guardrails. Voices will blame a villain of the moment. And once again, the question that matters will be simple and practical. What keeps payments clearing on Monday morning? The answer will point to the same place it did in 2008, toward the shadow practices that have become official practices, toward the pipes that carry credit through the body of the economy. Recognize the incentives, learn the signals, and keep a healthy skepticism for any product that uses the words safe, stable, and daily liquidity in the same breath as above market return. The most valuable asset in a world built on collateral and confidence is the ability to tell the difference between money and the many things that pretend to be money. Shadow banking failed in 2008 precisely because it was the banking system. When it choked, the world lost oxygen. The rescue did more than patch holes, it rewired the lungs. Central banks moved from lenders of last resort to market makers of last resort. Money became, more explicitly than ever, backstopped confidence in collateral rather than savings in vaults. The shadows didn't retreat after that. They stepped into the sun. They wear badges now. They sit at the policy table. And the next time pressure builds, the question will not be whether to support the pipes, only how much and for how long. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.